This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Businessweek Daily with Carol Massar and Tim Stenovec, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And a very good afternoon, everybody across Bloomberg platforms. Carol Massar, Tim Stenovec, and wait, did I walk in the wrong door?
No, this is the right place. Same show, new home.
You know, we did one of those like makeover shows and like over the weekend, paint, everything. This is where we are.
Well, here we are.
Yeah, same, like different background, but same stuff.
And you're stuck with us still.
You're still stuck with us, so sorry, but continue to send in the messages on the Bloomberg. Very good Monday afternoon, everybody. December 15th, the last full trading week of 2025, which is kind of amazing considering what a year it's been. We're not quite done. And this is going to be a week where we are going to get a lot of economic data points.
Yeah, it's going to be the backdrop of our program today. We are going across assets. We see stocks, bonds, and the dollar wavering. Investors prepping for more info on the U.S. economy. We're going to have more from Charlie in just a minute.
Yeah, looking forward to that, folks. And so this hour, what we were thinking is we've got to focus on all of those economic releases to come, Tim, this week. Inflation, we've got jobs. We're going to have a Jobs Tuesday. It's usually a Jobs Friday. You know, everything has been turned upside down because of the government shutdown. So we're going to get into what those data points might reveal about future Fed policy.
Also, the pursuit of Warner Brothers Discovery. Netflix
Not done
making
yet.
its case.
Not done yet.
The co-CEOs of that company out with a letter that says, hey, Hollywood, don't worry. All is good.
Yeah, okay. That always gets me worried when people say,
We love
don't
movie
worry.
theaters.
Yeah, exactly. All right, we're going to talk about that. Speaking of that expected deal, we are waiting to see if it closes in 2025, whether it carries over into the new year. But we're going to get into what has been a very, very busy M&A deal globally. So we'll talk about that among our most read stories on the Bloomberg.
Well, in the Northeast, it's very cold outside, and that just adds to the demand for grids. That's part of what we're going to be talking about. Is that why?
Yeah.
Okay. Well, we're inside, though.
I know.
Inside. Sally Librera is going to join us. She's president of National Grid New York. So also talking about grid resilience and AI demand.
Yeah, I'm curious about the spend, the build, and how they keep up with all of the power demand and whether or not they can build it all out fast enough. All right, let's get to the trade. We're pretty much hovering near our lows of the session when it comes to the equity trade. For an update on the session this Monday, let's turn things over to Charlie Pellet.
All right, I thank you very much. Happy Monday to you both. Certainly feeling the chill on Wall Street today. With the Dow, the S&P, NASDAQ, they're all in the red right now. Interestingly, though, down day for much of the equity market. Our Bloomberg Mag 7 index is holding on to a gain, up by 0.4%. But bottom line here, equities lower. Little changed on NASDAQ, on the S&P 500 index, down 0.1%, lower by 6 at 68.20. We've got NASDAQ down 77 for the NASDAQ Composite Index, down 0.3%, while the Dow Industrials are down 92 now, a drop there of 0.2%. 10-year currently yielding 4.17%, with a 2-year 3.50%. Gold is up 0.4%, 43.14 the ounce on the precious metal. West Texas Intermediate crude down 1.5%, 56.67 for a barrel of WTI, and Bitcoin now down 2.3%, 86,432 on Bitcoin. The two CEOs of Netflix are laying out the company's case for acquiring Warner Brothers Discovery after rival Paramount Skydance went public with a competing hostile offer. Now, in a letter to employees today, Greg Peters and Ted Sarandos moved to quell industry concerns about job losses and the end of theatrical releases. Paramount Skydance shares today, they're up 0.7%. Warner Brothers Discovery down 0.9%. Netflix down 1.3%. And yes, we'll have a whole lot more of this story coming up right here on Bloomberg Businessweek Daily. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. Coming to you from News Studios, I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, the big debate in the U.S. Treasury market over the extent of Federal Reserve interest rate cuts ahead is about to heat up, Tim. We've got a string of pivotal economic data releases, and it starts tomorrow with a bunch of reports on the labor market.
Yeah, it'll go a long way in filling the void created by the U.S. government shutdown. Delayed announcements of monthly employment and inflation figures, and then early January brings in more key jobs data. We've got with us Michael McKee, Bloomberg TV and Radio international economics and policy correspondent. He joins us here in the Bloomberg Businessweek studio. Also here, Meghan Robson, head of U.S. credit strategy for BNP Paribas. She's going to jump in with us in just a minute. Jobs Tuesday. We don't usually say that. We usually say Jobs Friday.
Usually say Friday. We haven't said that in a long time.
But are we getting a complete picture?
No, we're not. We're getting a partial picture, and it is also an old picture, so it isn't clear exactly how much difference it will make. I will defer to the smarter person to my left in terms of what the bond market is going to do about this. But you have to realize we're not going to get half of the October. We're getting October and November, but not half of the October report. We're not going to get the household survey, so we don't get the unemployment rate, which is what matters to the Fed. And we don't know in the October report how many of the actual categories in the establishment survey we're going to get either, because a lot of that comes in electronically, and some of it they have to call and get it, and whether they were able to call and get it or not, we don't know, which means for November, we're going to have a number for how many jobs were created, but compared to what? Is that compared to September, or is that compared to October and November? I mean, it's going to take a little while to figure all of this out. We also have one other big complication, and that is the federal workers. They were furloughed in October, so depending on when they were off the job and how many were off the job, they will count as not being employed. And then the Doge workers, the people who were fired or who took early resignations and had a severance, that severance ran out on September 30th, so that they would fall off as well. So we could have a big negative number, but you drop the federal workers out and it's slightly positive. And I think that's kind of what people are looking at with this 50,000 consensus in the survey.
All right, wait a minute. So we're not happy when we're not getting data, and then we're not happy when we're getting kind of weird data, right? I mean, Meghan, is there anything to it? Come on in on the conversation. Is there any value in this for you?
I think that the market does want to see some employment data. So I think it's good that we're starting to, even if it's backfilled and will be noisy, I think it's good to have that data. I think investors are also starting to think about 4Q earnings. And typically you just have GDP in other economic data that gives you a sense of how earnings will come in. So I think it will be a little bit of a relief to get past some of this data and see where it comes in.
Mike, if you're Fed Chair Jay Powell or a voting member of the FOMC, are you like, why couldn't we have gotten this data last week? but would it have changed any of the way that people on the committee voted?
We don't know. If we get a big surprise one way or another, it might have. The reason they couldn't is the Fed meeting was very early, and they extended the survey period for November to be able to get as much as they could, because they not only got started late, but they had Thanksgiving in the middle of it. So they weren't able to change it or get it in time for the Fed meeting. But I think what you'll see is Fed officials, they'll give us a feel for how they think about what it's telling them about the economy, but they're really going to wait for the December numbers, which we'll get on January 9th if we don't have another government shutdown, and that will be more of the basis on which they'll make a decision for the end of January meeting, although also with the CPI numbers we're going to get on Thursday.
Right, and I wonder if they're more important. We did know that Fed Chair Jay Powell, you guys know this, that he did say there's pressure on both the labor and inflation mandates on the Federal Reserve, and he talked about this being challenging. When it comes to inflation, Stephen Myron, the Fed governor recently appointed by President Trump, he shared his view once again on U.S. inflation. He spoke earlier today at Columbia. Here's what he had to say, guys. There was a large bout of inflation that resulted in an increase in prices after the pandemic. While American families are still rightly distraught with that experience and unhappy with affordability, prices are now once again stable, albeit at higher levels. Policy should reflect that. Meghan, Mike, you both smile. Is he right, Meghan?
So we at BNP, we're actually forecasting inflation to accelerate a bit into 2026. We think there still will be pressure on goods inflation.
Because of tariffs or because of?
Yeah, and based on tariffs and some of the delayed impact of goods. So we have inflation target around 3%. And so we do think there also will be some bumpiness in the labor market, potentially, as Mike highlighted for the January report. So we think we get one more cut next year, but that inflation will prevent the Fed from really extending a cutting cycle beyond that.
It's pretty much a universal view that we're going to see inflation accelerate because of tariffs into 2026. There's some question about when that falls off. Jay Powell said 6 to 9 months it could be that we see this. But the interesting thing about what Stephen Myron said, and remember he's there to give Donald Trump's viewpoint, was that inflation has stabilized albeit at higher levels. Well, wait a minute. That's what you're supposed to bring down.
So then there's inflation.
But that brings up a good point, and that's about the Fed's 2% target and whether or not that's actually a realistic thing right now. What do you think, Meghan?
I think that
given the environment that we're in,
I think it's going to take. I mean, look at their forecast. I think it's going to take some time for the Fed to get to the actual 2% target. And it does seem like, although they're looking at both sides of the mandate, Powell does still seem like he's biased towards the unemployment side of things. So if anything, we would likely get more cuts based on that posture.
Mike, will CPI help us out here in terms of giving us some more good information on inflation?
I don't think it'll give us a specific amount of information, unless it's a surprise, as I say, that will change Fed feelings, because I think they have a pretty good feel for where we are within a certain range. But the thing that is going to get people is, when do we have a feel for what unemployment is going to do versus inflation? And that's what you need to have, is the comparison, because right now they're betting on unemployment being worse. They're looking at the SOM rule, basically, and saying when unemployment starts to accelerate, it goes up fast. If it doesn't do that, but inflation doesn't come down, then they're going to flip their mandate and start worrying about inflation more.
You guys have been watching the Fed for a long time. If both of them are challenged, what are they going to be most? Let's say jobs gets better, but inflation gets, like, which one is more important, I guess, was what I'm guessing, in terms of the mandate. I'm not laying it out well. But, I mean, does one of them matter? They don't
want to say one matters more than the other. But what their official strategy is you look at the one that is farthest away from the goal that will be the hardest to bring back to where you want them to be.
Right.
And right now they think that's going to be unemployment, because they had been making progress on inflation until we got the tariffs and things started to turn around there. But there's another argument that there are some embedded inflation problems in the numbers that are not related to tariffs. And that's what they're going to have to be able to tease out here and figure out. I was thinking when Meghan was talking, since 2015, roughly, when they started putting out these summary of economic projections, 2% has always been their goal. But every year they move it 2 years out. Right now, we're not going to see 2% until 2027. Well, last year it wasn't going to be till 2026, and the year before that it wasn't going to be till 2025. So can they hit it? That's an interesting question.
2 years from now, maybe.
2 years from now.
2 years from, and 2 years from.
Well, the Fed does 2 years. Donald Trump
Also
does 2 weeks. You know.
Well, Meghan, on the dual mandate, what Carol was getting at, and this seems to be the core tension between different members of the FOMC. Which one is the priority in your view? What needs to get under control?
So we think they will protect what they will do, not necessarily what they should do. We do think they will protect the labor market. And so we think they are biased towards more cuts. I think that's partially why you're seeing asset prices so elevated.
At the risk of inflation. At
the risk of inflation, because you have the Fed at your back. You know, if unemployment, we do see a nonlinear sort of rise in the labor unemployment numbers like we did over the summer, the Fed is there to really cut. For now, we haven't seen inflation rising to any degree like we did outside of the pandemic. So I think that is lower on the priority list for now.
All right. So I want to ask you, Meghan, I want to stay with you for a moment in terms of the credit markets.
Sure.
and what we're seeing. It seems like we had a little bit of stress earlier this year, right, in terms of some of the regional, some of the, kind of subprime auto lenders and so on and so forth. What are you seeing right now?
So I think the debate right now is really around, are we seeing a transition from deleveraging to releveraging? And for most of 2025 through third quarter, we still really saw corporates very disciplined, not much borrowing, higher rates really impacted debt issuances. And then that sort of started to change in third quarter with the hyperscalers and just really chunky M&A deals in the expected pipeline. So for next year, we do think there will be a pickup in supply and an end to the quote unquote bond scarcity story, but we're still forecasting less supply than consensus. We think that rates are still elevated and they will dissuade some sectors outside of the known, utilities, hyperscalers from really borrowing too much. So I think that's the key story, especially in the investment grade markets.
You know, we talk a lot about the K-shaped economy, and that's kind of been like, you know, the backdrop of our conversations over the last few months. You note the credit market is K-shaped. What do you mean by that?
So K-shaped, I think it means a couple things. You have some sectors where you're really seeing CapEx expectations surge, and that they're expecting growth, and you're seeing borrowing on the back of that.
Technology.
So technology is a great example. I think utilities is another example. CapEx has increased 20%.
Related to the tech spend.
Related to the tech spend.
We're going to talk about like the New York power spend really a little bit later on this hour.
But on the other side, you have sectors much more tied to the consumer. They're growing much more slowly, and they're much more cautious about adding leverage. So we do think that there's a dichotomy there, and so overall credit can perform well. And part of it is you're not seeing that real animal spirits in a lot of the market.
Mike, when you think about the economy and moving into a new year, I mean, it's hard to believe all the kind of twists and turns we had this year, but what are the major risks to the economy next year?
Well, it's interesting because the president is touting, and some economists are writing into their forecast the idea that people are going to get bigger tax increases, tax refunds this year because of the president's tax cuts, and then they're talking about some sort of bonus checks. That's probably not going to happen. But the offset to that is the whole thing with the Obamacare premiums, because if you're going to get $1,500 back on your taxes, but you're going to have to pay $2,000 or $3,000 a month, that's not going to go very far.
Right.
So we don't really know what's going to happen, and I think the overhang of all this is confidence. I've said this many times before. Recessions are when confidence falls. And so it depends on how people are going to be feeling, which is kind of the tension you see coming out of Washington, is the Republicans are saying to the president, get out there and tell people how wonderful it is. And then people, when they hear him say, no, not so much. And so the Democrats are going to be piling on that side and the Republicans on this side. And we'll just have to see how people feel as the year goes on and all these things come at them.
Yeah, Meghan, on that, the way that people feel obviously has a way, an impact on the way that they spend, on the way that they think about the economy. How are you looking at that going into 2026?
I think for credit investors, there are some places you can position for some of the weakness and strengths that we're seeing on the consumer side. In the high yield market, we like mortgage servicers and originators. We think as rates continue to fall down and you have exposure to more medium, upper income consumers, that sector can perform well next year. And then on the other side of the coin, sectors that are exposed to not only lower income, but also that middle tier that's starting to show weakness, we think are places you might want to avoid. So leisure, out-of-home entertainment, places like bowling alleys, movie theaters in the high-yield market have really struggled more, and that's places we'd be more cautious on.
You're going to say you were just at a bowling alley.
No, I did bike by a bowling alley over the weekend, but I did not go inside. We hear from the cruise operators that everything is awesome.
Super rosy. Super rosy. You sound more cautious.
I think on the cruise lines are interesting because they do a lot of their revenue is pre-booked, so they could be booked for all of 2026, and so there is this sort of lagged impact on weakness that we haven't seen on the cruise lines. But to your point, we've seen cruise lines has been an area we've liked. We've seen upgrades, and they've done a great job deleveraging their balance sheets.
Mike, 20 seconds. John Williams, the president of the New York Fed, said monetary policy now well positioned for 2026. When he talks, it's important, right?
Well, when he talks, he kind of gives you an idea of where the chair is, because he's the vice chairman of the Open Market Committee, which by tradition never dissents. But we already know that because that's exactly what Powell said. So they're out delivering a unified message now.
Team, all aboard. All right, we got to leave it there. Michael McKee, international economics and policy correspondent here at Bloomberg, and of course, Meghan Robson, head of U.S. credit strategy at BNP Paribas. This is Bloomberg.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, NASDAQ. They're all in the red. Russell 2000 index also declining, down 0.6%. The Bloomberg Mag 7 index so higher, up by about 0.3%. But equity markets lower right now. First trading day of the new week. Last full week for 2025. With the S&P down 11 right now. 68.15 where we stand, down 0.2%. Dow Industrial Materials also down 0.2%. The Nasdaq Composite Index down 103 now, down by about 0.5%. 10-year at 4.18%, with a 2-year 3.50%. Gold is up $13 the ounce, 43.12, up 0.3%. West Texas Intermediate crude down 1%, 56.85 a barrel, and Bitcoin is at 86,200 now. Bitcoin down 2.5%. PME, that is a Dutch pension fund, has severed ties with BlackRock based on an assessment that the world's largest money manager no longer acts in its best interests on issues such as climate risk. BlackRock shares, they're down now by 0.4%. Recapping, S&P lower by 10, down 0.2%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, got to Charlie. Carol Massar, Tim Stenovec, live here on Bloomberg Businessweek Daily. We'll get back to Charlie in just a moment. Hey, 3 names that we keep watching: Netflix, Paramount, Skydance, and Warner Brothers. In terms of the acquisition, the pursuit, if you will, of Warner Brothers. Right now, Warner Brothers just down about 0.8%. Netflix is down, Tim, 1.2%, and Paramount, Skydance just up about 0.75 percentage point.
Well, Netflix co-CEOs Greg Peters and Ted Sarandos, they're trying to reassure employee concerns about the company's bid for much of Warner Brothers Discovery, reiterating that there's no business overlap and therefore won't be any studio closures. And, you know, they're like, actually, we like movie theaters and we think there's a place for movie theaters.
Yeah, like just some reassurance, right, out there. Just remember, we've got Netflix's $82.7 billion bid for Warner Brothers. It's a big one. The streaming and studio businesses was agreed to by the Warner Brothers board. Then you had Paramount Skydance come in, and they swooped in with a hostile $108 billion bid for the entire company. We've been following this saga. So we want to see where we are, because we did see Netflix's co-CEOs come out and try to maybe calm everybody down. Bloomberg News senior editor and entertainment team leader Chris Palmeri has been on this story, so we head out to the West Coast. Chris, it feels almost a little quiet today after last week's actions and felt like nonstop activity around Warner Brothers Discovery. What's the latest? What's new?
Well, you can be assured it's going to get a little louder later in the week. So today, Netflix comes out and is trying to reassure both employees and Hollywood about their intentions. They're still going to release the Warner Brothers movies in theaters, and they're saying basically to their employees, don't worry, we don't have a studio like Warner Brothers, and so that we're not going to be firing people en masse like, say, Paramount might. That was the implication there. But Paramount has reiterated its offers. Warner Brothers has 10 days as of last Monday to respond. So everyone anticipates, including Paramount, Warner Brothers to come out and say, we're sticking with Netflix, in which case the ball will be back in Paramount's camp to increase their offer more to try to lure Warner Brothers away from Netflix.
Chris, I'm going to ask you a very general question, and it's going to require you to paint with somewhat of a broad brush, but in general, how does Hollywood view Netflix? And is there a suitor for Warner Brothers Discovery that in general people in Hollywood would rather have?
Not another suitor, no. I think generally Hollywood would be fine with Warner Brothers continuing to remain an independent studio, and there wouldn't be all those mass firings and changes in strategy. The
so-called synergies that we've heard about.
Yeah, I mean, Paramount has said the number could be $6 billion. Now, a lot of that's likely coming from the cable networks that Paramount's acquiring of Warner Brothers, but still a staggering number, twice what Netflix is projecting. So yeah, I think Hollywood in general would prefer this, another studio hiring them and greenlighting new movies and all of that thing, rather than Netflix or Paramount.
All right, so is this it? Is there anybody else who could come in? Is there any other configurations that we might get out over this? Because I don't know. It just feels like
there's still, I spoke to Mario Gabelli last week. He still held out hope that Amazon or Apple would come in and make a giant bid at some point.
Well done.
But yeah.
Not Bob Iger or anything?
Definitely not Disney.
Okay.
Would it fit with those more tech-focused companies, Chris, or would it have an easier regulatory path?
Really hard to say. There certainly would be pushback at about big tech company increasing its strength in any way. But neither of those companies, Apple or Amazon, has a studio like Warner Brothers, this beautiful lot in Burbank, and so you could argue that it would be a good fit for one of them.
Hey, the Paramount deal, though, all the financing is there for it. I mean, we've been talking about the hit that Oracle has taken and what that does to the wealth of Larry Ellison, right, who was supposedly backstopping it. So is there any concern that if indeed Paramount, Skydance is the winning bid, that everything's there?
There is concern. We've been hearing from the Warner Brothers side that was one of the issues with rejecting Paramount, that they didn't feel the money was there. And of course, Paramount is saying the opposite. They've fully backstopped by the Ellison family.
How badly does Netflix want this?
Well, that's a question a lot of people have been asking, but I think you have to take the letter today from the co-CEOs at face value and they're still in the game.
It's because shareholders haven't been that supportive of Netflix's bid. I mean, we've seen shares down significantly since Netflix got in on this bidding process, Chris. Like, they're not convinced that this is necessarily a good fit.
Absolutely. I mean, they lost tens of billions of dollars of market value in it, and the closer Netflix gets to doing a deal, the more the stock seems to fall. If you look at the track record, I've sort of joked that Warner Brothers is like the King Tut's tomb of movie studios. Anybody that acquires it is cursed. And from AOL to AT&T to Discovery, those mergers haven't worked. So there's certainly reason to concern for either bidder.
Hey, we'd be remiss. One last question, Chris. Obviously, everybody thinking about Rob Reiner and his wife found dead at his home yesterday, stab wounds, according to sources close to the family. And we know his son, Nick Reiner, or their son, was arrested by the LA Police Department. I mean, our thoughts obviously go out to their family and friends, and it's shocking, the story. Just curious what you are hearing in and around the LA community.
Just shock, really. I was at a party last night when the first reports came out, and just amazement. I mean, you forget when you look at his biography of all the wonderful movies and TV shows he was associated with. They're really just such a part of our popular culture for 40 years now. The whole family, with his father, Carl Reiner, and that as well. So it's just a great tragedy.
All right, we're going to leave it on that note. Hey, Chris, thank you so much. Really appreciate it. Chris Palmeri, out there in our LA bureau for Bloomberg News, senior editor and entertainment team leader here at Bloomberg News.
Well, on Hollywood, we wait for an expected deal involving Warner Brothers to wrap up. We are curious, though, whether it will end up in the M&A league tables for 2025 or for 2026, Carol, which brings us to one of the most read stories on the Bloomberg terminal.
I love this story. It's about how the Dealmakers are heading into the final weeks of 2025 on that $100 billion cliffhanger that is the pursuit of Warner Brothers. Let's get more on the year in global M&A. Michelle Davis is in the house. She is Bloomberg News senior M&A reporter. First up, before we touch on the Warner Brothers pursuit, good year for global deal makers. Like, finally, right?
Pretty good, yeah. One of the best ever, arguably. And bankers have been saying, if it hadn't been for Liberation Day, it may have been the best one ever. Second best of all time, actually.
How big of a speed bumper, hiccup, was so-called Liberation Day?
It was, in the sense that deals were put on pause for 6 to 8 weeks.
I mean, do you remember that where all the IPOs that were set to be priced were put on pause for that? Like, every day there'd be like, hey, this company's put their IPO on hold, this company's, but then they all came back.
They did. And so we saw volumes at $4.5 trillion. It's all setting up for 2026 to maybe even exceed the record year that we saw in 2021. But folks that we talk to are always quick to remind us that, while everything does seem to be setting up for a really great 2026, 2021, the last record year, was a little different because we had rock bottom interest rates. And so that really propelled, private equity. That's the one leg of the stool that we haven't seen come back yet. Of course, everyone's predicting that, private equity buyers will come back in 2026, but who knows?
I think what's fascinating, Michelle, is just the kind of deals that were done. You've got railroad, you've got mining, you've got video games, and of course you have technology. I mean, we saw a lot of deals happening in a lot of different spaces and some good-sized deals.
Yeah, so the strength has really spanned sectors. It's been broad-based, and what's been interesting has been the size of the deals. So this has been a record year for deals over $30 billion. So it's the return of the mega deal. Over the last couple of years, we didn't really see anything above that $30 billion figure. This year we have more than 10 that exceeded $30 billion.
What's the theme that defines the deals? Because I look at the graphic that we just had up, and I'm reminded that a lot of the companies that have shed assets. Those assets have been bought up at pretty sizable stakes. And that's kind of where we are, at least in the business cycle right now, where these companies are saying to themselves, you know, separate is actually better. There's more shareholder value there.
I think the other thing that we've seen a lot of is companies are really shooting for the moon. They see a really clear and maybe easier regulatory environment than they have had for at least 4 years. And so they're all doing these dream deals that they'd put on the shelf. And, you know, they're just, again, shooting for the moon. They're, you know, contemplating deals that we haven't ever thought could happen, like railroad sector. Who thought there would be more to do there?
Right.
But, you know, they announced a deal. The Warner Brothers situation is another great example. And of course, you know, already one of those Warner Brothers deals, Netflix, Warner Brothers, that will be in the league table for 2025 because they signed a deal. Whether Paramount,
I was curious about that.
Whether Paramount upends that deal, you know, is another story. And that only means that if that happens, we could see an even bigger deal value at the end of, you know, when this finally gets set in history.
Before we go, you know, Michelle, I think about the role of the White House this year. Go back to Liberation Day, April, upending the markets, volatility, and so on and so forth, that really made a lot of corporate boardrooms nervous about maybe pulling the trigger. Having said that, then we kind of got back to where people calmed down. But you also had the White House taking positions in various companies. That was part of this, right?
Yeah, that's been a really big theme this year, has been, you know, the White House's involvement in deals earlier, from not only, you know, taking a stake in Intel earlier this year to, you know, the president making comments about whose hands he would like to see Warner Brothers ultimately end up in.
The AI side of this, I mean, a lot of the big deals were as a result of AI investments or money from these companies. How does that theme continue into 2026?
So it's part of why we've seen such a big pickup in TMT, but a lot of the AI deals haven't been, you know, what you'd think of as traditional M&A. They're like announcements about, you know, JVs or that sort of thing that don't necessarily reflect in the numbers. But the one thing about AI that's interesting when we think about next year is it came up as a swing factor that could cause all of this to end, in that, you know, if next year, for whatever reason, investors get spooked about AI and get worried that maybe there aren't as many use cases for it as previously thought, that could be something that causes, you know, the stock market to come down and then maybe impacts overall sentiment among CEOs.
Kind of the good, the bad, and the unknown, right, of AI. That kind of continues. Michelle, thanks. Michelle Davis, senior M&A reporter at Bloomberg News, joining us right here in studio. We mentioned AI. We're going to talk about the AI build when we come back, the electric grid power needed to keep it all going. We're going to talk to the head of one New York utility in the middle of it all. I've been looking forward to this, right?
I'm looking forward to it as well. I love talking power.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, NASDAQ. They are all declining right now. The Mag 7 index is advancing. That index up by 0.2%, but the S&P, keeping it all in context, it is down 0.2%. The Dow Industrial is down 0.2% as well. NASDAQ is down 0.5. The 10-year 4.18%, with the 2-year currently yielding 3.50%. Gold up 0.2%, 43.10 the ounce. And West Texas Intermediate crude oil, WTI, down 1.3%, 56.70 for a barrel of WTI. Bitcoin, meanwhile, down 2.5%. Bitcoin, 86,231. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Massar along with Tim Stenovec, live here at Bloomberg headquarters in New York City. You found this and you pointed out in our planning call, it was a report in the Albany Times Union, and they said over the weekend, National Grid and other utilities are spending billions of dollars to prep New York's electric grid for a generational shift, and it includes things like all of those AI data centers that are being built in the state and across the country, really.
Yeah, the paper went on to note that New York utilities are spending that much money to modernize the grid for those facilities. Their investments for New Yorkers, many of whom are already struggling with utility costs, are going to have to pay for that in the coming years. But the idea is that we're prepping it for the future.
Exactly. But so how uncomfortable as the build out happens and the stress on the grid continues. Let's see what our next guest has to say. We've been looking forward to this. Sally Librera is President, National Grid New York. It's a subsidiary of the publicly held electricity, nat gas, and clean energy utility, National Grid PLC, serving millions in New York and Massachusetts. National Grid ADRs trade in the U.S. They've got about a $75 billion market cap. They're up more than 27% year to date. So nice to have you here. How are you?
Great to be here. Thanks, Carol and Tim, for having me.
Well, it's great to have you here. How would you describe power demand today and how that demand is growing, surging? Use whatever word makes sense so that we understand what's the current situation.
Sure. So at National Grid in New York, we serve more than 4 million customers, and we deliver natural gas and electricity to those customers, and our focus is on doing it safely, reliably, and affordably. But the reality is there is increasing demand for energy across the entire state. And we serve through upstate, we serve in Long Island, and we also serve in New York City. And it's our job to deliver that energy, to meet that energy demand where, when, and how folks need it.
How would you quantify that demand, though? Give us some idea, because we're talking nonstop about deals of AI data centers, whether it's New York or elsewhere. Give us an idea. How stressed is the situation?
So we work with our New York independent system operator, the NYISO.
Yeah.
And NYISO manages what we call the large load queue. So it's essentially the companies that have indicated wanting to hook into the New York grid that have large power needs. And they estimate that the cumulative power need across those companies that are essentially in line to connect sometime over the next 5 or so years is about 10 gigawatts of energy. And so just to give you some context, at our peak in New York, we demand about 3 times that across the entire state. And another really important point is that 1 year ago, that queue was 1/3 the size. It literally tripled in just 1 year.
All data centers?
No, not all data centers.
What is it then? Because it does seem like for many years, we thought that power demand across the country would actually stay relatively flat. And it did stay relatively flat. But just in recent years, we've seen so much of an uptick in demand. What are you seeing on your grids? Well,
there definitely is the impact of data centers, but New York is also very attractive to manufacturing, and large-scale manufacturing, particularly some of the modern manufacturing we see around semiconductors and computer components. It's very energy intensive, and companies with big power needs are drawn to New York. And we are working to make sure that they have the power that they need, not just today, but well into the future.
So it's interesting, right? Because we think about this White House, right? And encouraging investment from foreign companies to build here. I mean, I guess, that's the good thing, right? We want to see other companies investing into the United States, but there's a power grab on that too, right? As a result of that, in order to meet that.
Well, I think
potentially.
I think it is important to note that even if we weren't at this unique moment in time with rapidly increasing demand for power, we still have a grid in New York, and this is true across many places in the country. We have a grid that needs investment. We have assets that are close to 100 years old on our grid.
Why, right, Tim, how many people, why, if it's 100 years old, why 20 years ago, right?
Why didn't we make the investment then?
Yeah.
We've been...
Politics, I'm guessing part of it.
That was a long pause.
Please, you answer the question.
Trying to understand, because it's important.
We have been very careful about balancing the bill impacts which customers bear with the investments that we make in our infrastructure. And even today, where we look at assets that are 70, 80, 100 years old, we're very strategic and pinpointed about which of those assets, which of those parts of infrastructure we replace, because we want to keep customer bills low. So we look for those opportunities where we can do multiple things with an investment, where we can replace an aging asset with something that's more modern and something that can carry more energy, something that can unlock more energy that our generators have to connect into the grid, and something that's going to be more resilient to storms and better leverage technology so it's cheaper to maintain.
Does more resilient to storms mean burying power lines? Is that the way to do it?
In some cases we do that, but it's also the type of infrastructure that we put up. We are replacing in places sometimes wooden poles with steel poles, just much stronger infrastructure.
Well, and I think about how do you balance all of that? Affordability, as you know, has become quite the word that we are hearing a lot, certainly in the political environment. So how do you keep your investors happy and the grid reliable without rising bills that make your customers furious and invite regulatory and political pushback? I mean, that is a hard mandate.
It is a difficult balance, and it's one that we navigate every single day. We do it through a number of avenues. We certainly work closely with our customers to help them manage costs, and we do that through a variety of bill assistance programs and energy efficiency programs and rebates. And we have consumer advocates whose job it is to specifically work with folks in communities to help them manage their costs. We also, as I mentioned before, are very careful about where and how we invest in assets, and we make sure that if we're investing in an asset, that we're going to get more power from investing in that asset, that we're going to get more resiliency, and that we're going to get more efficiency from investing in that asset.
The president has been outspoken about his disdain for certain renewables, especially wind power. Your investment in renewables or sourcing energy from renewables, has that changed under this administration?
Well, we certainly support the all of the above energy approach, and are pleased with the most recent version of the state energy report that's just come out today that leans into an all of the above approach. Given the rate at which demand for energy is increasing, we need to be utilizing all of those opportunities, from renewables to natural gas to nuclear, to make sure that folks
is that
have
more
the energy
difficult
they need.
if the federal government is not supportive of certain renewables?
We are working on the infrastructure to move power from point A to point B. So while we support projects like, say, the Nessie pipeline, that's a supply project. It's not our project, but we support it because we know how critical it is to the downstate community and how reliant New York City and Long Island are on natural gas, and how thin that reserve margin is. And their demand for energy is growing as well. So we support Nessie for those reasons. The other side of our business is about building transmission. It's about building the highway over which the power moves. So the sourcing as to where it's coming from isn't a national grid decision. We work with generators of all kinds.
You know, bottom line though, does this potentially, as you guys are very careful about when you invest so that power prices don't go up, but are there going to be moments where prices are just going to go up just because of the environment, and it's hard to kind of predict everything? And forgive me, just got about 30 seconds.
There are moments, and now is one of those moments where customers are seeing increases on their bills, and that's for a number of reasons, but primarily it's to be investing in infrastructure that is necessary. Those investments are necessary to make sure that folks continue to have the safe and reliable energy that they need.
And those investments include renewables, green, all of it.
Well, we're investing in the ability to unlock those energy sources and be able to bring them onto the grid and move them at a greater frequency.
Okay. We could go another 60 minutes, so hopefully you will come back soon. Really appreciate it. Sally,
thank you for having me.
Sally Librera, she's president of the National Grid New York, joining us right here in studio.
Hey, coming up next, stocks on the move. And speaking of indices on the move, the S&P 500 down 0.2%, the Dow down 0.2%, the NASDAQ, though, the underperformer, that's down 0.5 percentage point. This is Bloomberg Businessweek Daily.
All right, everybody, we're coming up on the last hour of trading on this Monday, December 15th. Carol, Massar, Tim Stenovec live here at Bloomberg headquarters in New York City. We're bouncing around our lows of this session. Little changes, though, overall. Just down about 8 points on the S&P 500. You've got the NASDAQ 100 down about 86 points, 1/3%. So a little bit of pressure, but we get some economic reports, which
I was just going to say.
At the top of the hour.
Yeah.
Some of it might be useful, some of it might
Tomorrow's a Jobs Tuesday.
A Jobs Tuesday.
You get a couple CPI reports.
Yeah.
Maybe little one's incomplete. One of them's a little incomplete.
Yeah.
But look, some data is better than no data.
Yeah, I guess so, right? Like, I mean, we'll piece it together, and definitely helpful. And I'm assuming the markets and investors will be looking at it.
I'm Tim Stenovec along with Carol Massar. Let's take a look at some stocks on the move today. We're joined by Alexandra Semenova. She's Bloomberg News equities reporter. Alex, stocks on the move today. No shortage to choose from.
A big move for this one. iRobot filed for bankruptcy, and
I'm
is
so
handing
sad.
Over, it's very sad. This is a very
I've had
nostalgic
so many Roombas
stock.
in my house.
Okay, wait. Have they actually been Roombas, or were they knockoffs?
No, we were like early on. I mean, we had
you went full
for our dogs, like
Roomba.
for our Dalmatians, which we don't have anymore. They're gone. Sorry, guys. But I mean, and we had one to wash the floor, and went through a couple different iterations. So we are.
You're on. Okay, now that we've done
go ahead.
Alex, go.
Well, apparently the problem was that not everyone like you, Carol, was buying the original. People were buying the Amazon knockoffs, which didn't fare well for the company, hence it giving over control to its main Chinese supplier. The common stock of iRobot will be wiped out under the proposed Chapter 11 plan. It listed between $100 million and $500 million worth of assets and liabilities in the filing. And if you look at the share move today, it's down more than 70%. So a really brutal day for this company. Bad day for carpets as well, I guess.
If you have a pet, it's like it's really fun. Like you let it go and the pet like goes
I've
after
seen all the
it.
videos of dogs like jumping onto them.
The challenge that we always had with these, because we had one of the knockoffs, the challenge that we always had was you had to have like no obstacles in the way.
I'm sure that you have to monitor it, make sure that it doesn't get like stuck.
And I would also just stand there watching it, and I'm like, I'd stand there watching and be like, and my wife's like, are you actually saving any time if you're just going to stand there and watch it? Like, couldn't you just be vacuuming and do it more quickly and waste less time?
I don't remember the original. Like, it would go under the couch. It would go, like, the only thing you had to be careful is if you had a rug with, like, fringe and so on and so forth at the end, it could chew it up a little bit. Maybe if you didn't buy the knockoff.
Remember Amazon offered to buy this company and it wasn't allowed to? So that's
it would have been a great change of fortunes for them, but
okay.
Rest in peace, Roomba.
I guess there are other stocks you want to talk about.
Yes.
Yeah, so Michael Saylor's strategy is also a big one today. It acquired almost $1 billion in Bitcoin for a second straight week as the cryptocurrency has been falling. This was the largest amount of Bitcoin acquired since July and its second straight week of buying over 10,000 Bitcoin to its books. It used proceeds from sales of its Class A common stock, which is a model that some critics say dilutes the existing shareholders' equity. There has been market speculation that the company might be removed from some key equity indexes, but the NASDAQ 100 actually opted late Friday to keep strategy in the index when it had its annual reconstitution. Shares are down right now. It looks like 7%, and of course, Bitcoin has been tumbling to this year's lows. It is down about 30% from an all-time high of just over 126,000 in early October.
I thought we were seeing some momentum last week when it was, above 93,000 per Bitcoin, but that didn't stick.
I just don't understand. Like, are they? I keep thinking that are they just creating demand here?
You're talking strategy specifically?
Yeah, you would think that their purchases are a test of confidence for Bitcoin, but them buying it up clearly isn't helping the cryptocurrency right now. And what's interesting too is it's not like there has been kind of a risk-off mood on Wall Street. People are still buying stocks.
Right.
But Bitcoin has been
Tesla could end at a record today, or so my co-host reminded me. Where do you want to go? Number 3.
Last one is Zillow. Shares of the company are tumbling today. It looks like it's down about 8.4% right now. This is after a report that Alphabet's Google has begun testing a new advertising platform for real estate listings. This threatens portals like Zillow and of course some of its competitors. If you look at CoStar Group, which is owner of Homes.com, it also fell as much as 9.1% today to a July 2022 intraday low. Google's listings basically allow users to view full details of a property right as you search it. You can request a tour, contact the agent. Goldman Sachs said they don't expect a direct near-term hit, but this could be a problem in the long run.
Wow. That feels like a big deal.
It is.
Right?
A nice little preview of one of my, two of my
declinings.
They could change, subject to change, but good choice, Alex.
All right,
Life's happiness.
All right. Alex Semenova, she's Bloomberg News equities reporter. Be sure to check out our Stock Movers podcast. They are 5-minute episodes of the biggest winners and losers in the stock market. You can find it on Apple, Spotify, or anywhere you get your podcasts. All right, we're wrapping up, almost headed for the last hour of trading here.
Yeah, if you're sticking with us on a Bloomberg Businessweek Daily, we got a great program coming up. We just spoke to the president of National Grid New York, Sally Librera, all about energy infrastructure. Well, next hour, we dive into the consequences of what happens when demand exceeds supply, not just here in the U.S., but around the world. There are some serious economic consequences.
Yeah, something to think about when it comes to global growth. And we're also going to, of course, count you down to the close, look at some of the winners and losers, and an fascinating story among the most read about McKinsey & Co. when it comes to their workforce. This is Bloomberg.